Hello, everyone. We're going to get started in just a moment. Sorry for the delay. We're doing this on a new platform and, or I guess a new software, which is broadcasting on different platforms. So people are joining us on YouTube, they're joining us on Facebook and a few other different channels. So we'll just give it one more minute and then I'll get started. Okay. Did I lose you there, Adam?
No, I'm here, I think. Can you hear me?
Yeah.
Awesome.
All right. Let's jump right in then. Okay. Adam, thank you for joining. Always a pleasure. For those of you joining us, sorry for the delay again, new technology, and we have people joining us from different platforms. Tonight, we're going to talk about creating multi-generational wealth and how wealthy investors build it and how wealthy investors keep it. Let me just get my technology platform ready here. And, let's start with some introductions. Adam, go ahead.
Well, just first of all, it's a real pleasure to be here with you and your clients, Ryan. Thanks for the invite again. I love these chats. And for those on the session that don't know me, I'm a mortgage broker with Dominion Lending Centers. I've been doing it for 20 plus years, which just means I'm really, really old. Sorry, I look like a lobster. Had a quick visit to Florida and the lighting's making me glow red, but I figured that would just add to the excitement of the call. So thanks again, Ryan.
and Adam has been my mortgage broker for many years now, and he's helped me get deals done that other brokers couldn't help get done. So I know you've helped a lot of our clients, and it's just great to have you here, and hopefully you can help more of our future clients. Myself, Ryan Coyle, a lot of you already know who I am. I'm the broker and founder of Connect.ca, real estate brokerage. I've been a real estate investor for 20 years. Started at the age of 20, 15 plus years as a real estate broker, founder, owner of Connect.ca Realty, Marco Toronto Property Management, and One Day Money. I am part of a top producing team of resale and platinum agents, and I have a portfolio of over 40 doors and a value of over 37 million. Which we'll talk all about. Connect group of companies quickly, just so you guys have a little bit more context about what we do. Connect.ca, again, is a small real estate brokerage. We deal mainly with investors. We take more of an investment advisor approach to selling real estate. A lot of our sales and success investing and working with clients have been in the pre-construction market. We also do a tremendous amount of resale on the listing and buying side. Our inner circle is an exclusive club of our best clients where we bring in speakers, and we do stuff like this, and we network, we share ideas, and we bring in educational people and hopefully help everyone learn. Marco Toronto is my property management company. We acquired it in 2019, and Marco Toronto has been managing properties for both investors and homeowners for 20 plus years. They do a lot of furnished rentals and they do a lot of non-furnished rentals as well. So we deal a lot with the executive and film industry, and we do a lot of short-term furnished stuff. And then I think we have probably over 200 unfurnished rentals as well. And they're managing all of my properties, which I love because it's completely hands-off, and they manage most of our good clients' properties as well. One Day Money is a private lending division I started several years back that allows pre-construction investors to tap in the equity from putting a deposit on a condo to closing on it, and allows them to use their equity to sometimes not have to pay any closing costs or further deposits. And One Day Assignment is similar to One Day Money. It just has cash available to help people liquidate to get out of pre-construction deals if they want to. Agenda. So we got a lot to talk about. I'm going to move quickly. For those of you just tuning in or tuning in later, I'll probably say it a few times throughout. We're recording this. We're going to send it out to our database. It's going to be on YouTube. And, if you can't stick around, you're going to get an email with all of it. So I'll go through what we're going to cover. And then if you don't want to stick around for that length of time and you want to just check in later, you'll have a video and you can just, go through it at your leisure. How to create multi-generational wealth through real estate. So this is what I think is one of the most important topics for not just investors, but Canadians right now. Multi-generational wealth is a very important thing, especially, with everything going on in the world with inflation and home prices. So why multi-generational wealth is so important. We'll talk about that. We'll get into the power of leverage, compound interest, passive income, and the refi repeat process. We're going to look at my portfolio and, how I built $100 million portfolio and why pre-construction condos were the best asset choice for me to be able to do that. And the Toronto real estate market update and outlook. So what the heck is going on in the market? I think some of this is micro, some of it is macro. I talk mainly about Toronto and the GTA, but some of these are more macro issues. So I think there's a lot to talk about there. And I'd love for you to jump in at any point as well, Adam, because I know you know this stuff inside out.
You bet.
Why the future of Toronto real estate has never looked better. We're going to talk about that. And, some of you might say he's crazy, he's a sales guy, but trust me, Toronto real estate has never looked better for the long term. Investment opportunities. We're going to talk about a blue chip investment opportunity at downtown Toronto, 8 Elm condos. And then we're going to send out another one. I didn't have time to put together in the presentation, and I just thought it would be too long, to be honest. So Radio Arts Condos is an amazing project in Hamilton. I've been investing a lot in Hamilton. It's a great, great market. And then Q&A. So we've got I have all kinds of questions for you and the mortgage industry. So we're going to leave our questions until the end. Some questions will be for me. That's great. Some questions are going to be for Adam. Adam is an expert working with investors and helping them refinance, buy more properties than your bank would tell you can buy. So really important conversation and person to have here. And let's jump right in. I'm talking so fast, I'm going to be drinking a lot of water. So how to create multi-generational wealth through real estate. And I think the most important best place to start is, why is it so important? And, Canadians are living longer without enough savings. Pensions are rapidly becoming a thing of the past. Before I get into these points, when I got into real estate, actually before I got into real estate, I grew up and growing up in a household full of teachers. My mom was a teacher, cousins and uncles. They talked about two things all the time. And it was, summers off, and it was their pension. So they had a lot of pride in their pension, and they felt very comfortable with that. And I always listened to that and started understanding why that was important and what it was. And I just knew I didn't want to be a teacher, and I wanted to be an entrepreneur. So I, from a young age, thought about real estate. I've thought about how I could use real estate to create my own pension. And that's really where I started 20 years ago, and what I help my clients do as well. So, at that point, it wasn't that important. My goal was to own 10 condos, and you'll see I own a lot more than that now. But that was the goal. I worked backwards. I'm like, I need 10 condos. I'm going to retire at 60, and I'm going to be able to live a great life. I didn't think I was going to live to 120, and now I think I might. So I think that's changed, and that's why I got 20 condos, right? 20 plus. But so change in life expectancy at birth, Canada since 1920, as you can see here, we're living a lot longer. And, 30% of Canadians will live until they're 90 plus. 500,000 Canadians are expected to retire this year. According to a 2019 TD study survey, 64% of Canadians, nearly 2/3, expect to work in retirement due to lack of savings. 1 out of 3 retired Canadians are still working, and 1 out of 5 retired Canadians working up from 1 out of 5 from 2015. Defined benefit pension plans are expected to be gone by 2026. And in order to have financially secure retirement, invest in real estate is the best option. So, I think it really is. And I don't think this is really a new thing where people are investing in real estate to create multi-generational wealth. I traveled a lot over the last year or so going to Europe, and I'm always fascinated with real estate. When you go to these old cities, you see real estate prices and how high they are. And it's majority a rental market. There's a small resale market. The majority of real estate is owned by very wealthy people that have passed real estate down through generation. And you see that in cities like New York and soon Toronto, or already now Toronto as well. Toronto's still a relatively young city. And this kind of ties into this next slide: declining home ownership rates due to increasing values. So buyers are getting priced out of the market. Will it be impossible for future generations to buy real estate? And for many, it will be. And, you can see this decline here in terms of percentage of ownership. And, it's a steady decline. Well over 4 in 5, 85% of those who have young children are worried about the future affordability of real estate. 33% of homeowners admit they need help from their parents when purchasing their first home. Owning real estate will be impossible for future generations. These are all points I've taken from different articles. According to the survey of financial security, the net worth in 2019 constant dollars of homeowners rose. This is staggering. So rose from 323,000 in 1999 to 685,000 in 2019. In comparison to the net worth of renters of ages rose from 14,000 to 24,000 over this period. So, to leave a legacy and ensure your children and grandchildren can get into the market, the best option is to buy real estate and to be able to pass that on to the future generations. And, I think that this is a really important point, that, creating net worth, a higher net worth and funds to be able to retire comfortably is best done through real estate, and is performed that way over and over time. So let's look at how I created multi-generational wealth and how I'm doing it. And it's through pre-construction condos mainly. And the power of leverage is a really, really key factor in that. So what is leverage? Other people's money, OPM. It's essentially buying an asset for X amount of dollars, call it 500,000, putting down a deposit, call it 100,000, borrowing the other 400,000. That is the leverage. And you're buying with the bank's money and you have a 10 pay them back. Pre-construction is the ultimate leverage because it allows you to invest actually without a mortgage. I mean, to me, that's just crazy. When I figured that out, I was buying multi-residential. I bought my first condo. It closed about 4 or 5 years later. I made about 180,000. This is in 2004. So that was a lot more money in today's dollars. Refinance that, bought my first sports car, went and bought 3 more condos. I was like, this is great. This is amazing. And I did all that without having a mortgage. I got the mortgage, refinanced it, and it was easy. I actually went and sold my first 5-plex, my first property I owned, and I bought more condos as well. So that's kind of how I got into it. By the time you take out a mortgage, you have, then I should add, it allows you to invest without a mortgage. I mean, look, I love you, Adam, and I know you make a living doing mortgages, but.
Yeah, that's it. I'm hanging up. No, I'm kidding.
But look, what kind of real estate investment can you buy in without a mortgage? You could buy in a REIT, but you don't get the leverage, right? You can't get the leverage. When you're buying a pre-construction condo or property, you're getting the full amount of leverage as though you have a condo, and it's often less than 20% because we're buying pre-construction condos for 5% down, getting the full leverage of 95% of the asset and not having to worry about high mortgage rates or anything at all. It's just putting it in your filing cabinet, forgetting it for 5 years, and then we call you. But that's really when the snowball effect happens, right? That's when you take the equity out of that and then go double down and do it all over. By the time you take out a mortgage, you have price and rent appreciation outperforming the market with serious equity. And then a really major thing, it helps you create passive income. It's income while you sleep. And the reason why that's so important is you can't work 5 jobs. I mean, maybe some people do, but that is very taxing. That is a very difficult thing to do. You can own 5 properties, you can own 50 properties, and they earn money for you while you sleep. And that's why passive income is so important. More importantly, multiple streams of it, which we'll get into. And then I love including quotes. I read a lot of books, and some of these things have really connected with me over the years. This is Robert Kiyosaki, the author of the famous book, Rich Dad, Poor Dad. Leverage is the reason some people become rich and others do not become rich. As simple as that. So the next kind of metric in the formula of creating multi-generational wealth with pre-construction is the miracle of compound interest. And Albert Einstein said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And what I've done here is I've taken 2 examples of compound interest, and I've taken the Toronto Stock Exchange over the last 20 years. I've taken the Toronto real estate market over the last 20 years, and you can see the returns here. So the long-term average is considerably higher than the TSX. So the big difference here is the leverage, but adding the compounding interest to it. So $100,000 investment made in the TSX in 2022, 20 years ago, would be worth $275,000 today, or 176,000% ROI. Really great. But when you factor in the compound interest and leverage, and you're getting compound interest on the leverage, this is just like, there's no comparison. So $100,000 investment made in GTA condos in 2022 would be worth $432,000 in 2022. Once you factor it being a 20% deposit on a condo, your deposit of 100,000 20 years ago would be worth 2.163 million today. And that's based on a 20-year average of 7.6%. I can tell you the 5-year average is much higher. The 10-year average is much higher. The 45-year average is actually just around 7%. So that includes a couple of recessions, which I'll actually get into as well. So passive income, earn money while you sleep. And this is really, you know, the leverage, the compound interest, and then doing multiple streams of passive income. This is really how you create wealth. So Warren Buffett said, if you don't find a way to make money while you sleep, you will work until you die. Pre-construction condos are as easy as owning a mutual fund. And that's why they've worked for me. You can put down multiple deposits, not have to worry about mortgages at the time. You worry about them down the road. They do appreciate and accumulate equity, historically speaking, so that when you actually take out a mortgage, it can help you get other mortgage options. You know, so it helps with financing. You know, and to be honest, like I've got a lot of properties in my portfolio. I would have never been able to own that many resale properties. It's a lot of work. It's a lot of time. By buying multiple pre-construction condos, they're staggered. They close over time. I use equity from this condo to help with that one, and so on and so forth. So it works really, really well for accumulating a lot of real estate. Passive income, $54,600. Okay, so this is really important. $54,630,000 was the average salary in Canada in 2021. The average Toronto condo price right now is $736,000, and saw 7.5% average growth over the last 10 years. So if you just say over the next year that we see 7.5% growth, which some of you may think I'm not saying the next year, we'll get into all that. That's $58,000 increase in your net worth. So you're doing nothing if we're managing it for you, but you're probably doing very little if we're not. And, you know, that's one condo at the average price. If you've got 30 of those, you can just add, you know, 30 times 58,000. You could do, you know, probably not that quick math, but it's a lot of money. And that's really where you'll see when I show you my portfolio, how all of these variables and metrics have just snowball affected into compound into a large portfolio of real estate. So multiple streams of income. So, you know, you do that once, passive income, do that multiple times. Refi, buy, repeat. So equity, maximize your portfolio and build serious wealth. Equity in your property isn't working for you if it's sitting there. You need to make it work hard. So what that means is if you bought a condo 5 years ago and closed on it today, a $500,000 condo, it'd be worth around $800,000 today. So you would take out a mortgage of 20% of the 500,000, but you'd be sitting on a ton of equity. You could actually take out that equity and use that to invest more. Okay. And then I'll talk about tax advantages in a minute. So most Canadians are sitting on an amount of cash in their primary residence. They don't even know it. So I'm talking about investment properties, but a lot of people, Adam, maybe just touch on that, because I know you've worked with a ton of our clients to help them tap into their home equity, investment property equity, and maybe just touch on how that all works.
Yeah, I mean, I'm loving everything you're covering here, Ryan, by the way. For sure. I mean, one of the first things we do normally when someone approaches us and says, oh, I want to be a real estate investor. I watched Ryan Coyle's presentation. I want to do this. We do what's called a pre-positioning in my office, where we just get organized and we take a look at the current situation. It surprises me how many Canadians don't really know what they can and cannot do. So the basic rule, you can do some mental math sitting at home, is on your primary residence. Technically, you can borrow up to 80% of the value.
Right.
So if you had a $500,000, just for simple terms, $500,000 home value, you could borrow up to $400,000. And so if you currently have a $100,000 mortgage on that $500,000 house, technically you can tap into $300,000 via home equity line of credit or a mortgage when you look at the whole thing. And that's an awful lot of deposits. And that's what we call like setting people up for success. You don't have to pull the trigger immediately, but you get set up, you get organized, and then you go about your business like you're talking about, Ryan, and leveraging and building wealth.
Yeah, it's brilliant. And, some people don't like the idea of pulling money out of their home. There's some more old fashioned or conservative people. So I think there's a lot of variables you need to consider. I mean, like, we work with numbers. I like looking at numbers. So, best case, worst case scenario, and real estate over the long term is going to help you achieve multi-generational wealth in a big way. If you have equity in your property, you should be having these conversations with Adam.
And on that note, on a primary residence, there's actually some amazing products out there with the banks where they actually allow you to compartmentalize. So I sort of just lump summed it in and said 80% of value. But you do have the ability to compartmentalize, to have a chunk of equity over here that you're using to invest, and maybe it's not blended in with the mortgage you're trying to pay off on your primary residence. And for a lot of people, that's very relieving, because they kind of want to have both goals. Some people, they're much more aggressive. It's fine, but there's lots of great products out there so you can keep your investing separate.
Yeah, it's a good point. And then another really, really powerful thing, which just blows my mind, I actually think this is the biggest, strongest tax deferral to ever exist, is that when you borrow money to invest, so I've refinanced my home, I take that money, that then becomes a tax deduction. So I'm actually lowering my taxes. But the other thing is, okay, that's my primary residence, that becomes a tax deduction. But if I have an investment property, there's a few ways to take cash out of it. You can sell it, or you could refinance it. And if I sell it, I get hit with a really big tax, capital gains tax. And depending, on your tax rate and a number of variables, that could be big or low, whatever. But by refinancing it, you actually don't pay taxes. And I don't want to get in trouble. You do pay taxes, but it's when you sell the property, whether that's in 10 years or 100 years. Yeah. So it's a crazy tax deferral where you can take out money, put every cent in your pocket and reinvest that, and then deduct the tax from your actual income. So it's a very powerful thing for many reasons. And then this is exactly
you're actually getting a personal income tax deduction on interest that your tenants are actually paying if you're doing it on investment properties, and that's just what's just unbelievable.
Yeah, it's crazy. I got to figure out some sort of model that shows what that return actually ends up being when you add all those things in, because it's just ridiculous. Yeah. Anyway, I don't want to talk about it too much in case. So, those are all the principles I use to build a $100 million portfolio. And, we'll look at that later by what I mean by $100 million portfolio. And, everyone always asks me, how do I start? How do I do it? And honestly, I say dream, create a goal. You have to start with a goal. My goal is to own 10 condos, and I worked backwards. I went to talk to people, that had as much experience as I did back then. And I read books, and I mean, the internet's crazy now. There's so many resources. So there's so many ways. And then you really need to create a plan. So you create the dream, you create the goal, then you create a plan. So that's the, meet with people, jump on webinars, do all that stuff. And then you actually take action. So, it's a dream without action. And that's the most important thing. And, the best thing to do is work with professionals who have done what you want to do. And that'll help you to achieve your goals much, much sooner. So why pre-con? We touched on some of this. It's easy hands-off investment. So it's completely hands-off. You do the deal. 90% of the time, you don't need a mortgage commitment. You just need a mortgage letter, which is very easy to get. It's the ultimate leverage. So there's no mortgage. You can do more with less. You open my filing cabinet, I got a lot of deals. Those are my properties. Other people are going to mow their lawns or doing things. I just open my filing cabinet, like, oh yeah, they're all there. They're closing eventually. And then I talk to Adam. But the other really great thing is it outperforms older condo inventory. So, to put that in perspective, these numbers are a little bit off with the changes in the market and everything. And I haven't updated this, but this is a very, long-term kind of look at it. So they're not that far off. But GTA pre-con 5-year average is 13%. So that's all of GTA 905416. 13% versus 11.26% detached and 7.1% existing condos. Now, when you look at the pre-con downtown average, it's 15% versus 11.4% for detached and 6.51% for existing condos. And, I'll get into why downtown Toronto is the blue chip of real estate investing. It's where I started. It's where most of my properties are. And we'll get into all that. And then the 5-year average or 45-year average for Trev is 7.1% with multiple recessions and, market peaks and troughs. So we'll get into that as well. Time equals money and it reduces risk. So less liquid, but less risk. So when you buy pre-construction, it is not liquid. But that's fine because time in the market, not timing the market. That is how you reduce risk from any I shouldn't say any investment. With real estate, you reduce the risk, pretty much eliminate it by doing a long-term gain. For me, all of my investments have long-term. So when I buy, I look at it as a 20-year. I'm like, I'm going to have 1, 2, maybe 3 recessions. But I know looking at long-term numbers and short-term numbers and the fundamentals of market supply and demand that I am going to see a minimum of, I look conservatively at 5% growth. I've undershot by about 50%, but that still makes it a really good investment and it takes the risk out of it. So to put all this kind of into action, I'm going to give you a perfect example. And actually, Adam helped me with this property. And we're in the process of another one, which I'll hopefully hear back from you any day. Yeah. So purchase price was, this was April 2017. So I bought it for $602,900, had it appraised at a great appraisal at 1.175. It would probably be a little bit lower right now. We'll get into all that. Current rents. So rents are up like really high. When I originally had this appraised, my rents were, I think, $3,000 and they're now $3,900 in just like a few months since the tenant left. So it's pretty incredible. And then the current mortgage was $482,000. So that was based on 20% of this. And then the refinanced amount was $457,000. So Adam actually got me a check for $457,000. I didn't pay a cent of tax on it. And I went and you know what I did? I went and bought more property, as you know, Adam. So, just kind of break that down. So $1,175,000 appraisal, 80% equals $940,000 of equity. I had to pay down the outstanding mortgage, which left me with $457,000. Adam helped with that. Very happy with how that worked out. Now, what's that?
I said, good.
Just showing you kind of how this works, the multiplier effect, how it works over, a longer period of time. I forget the fundamentals or the appreciation we used for this. I think I used 5%, but and this is low. So maybe we're buying a condo in Hamilton, but a $450,000 purchase price, 90,000 down. In year 6, when you close on it, you can actually refinance condo 1 and buy property 2 and 3. And then in year 12, we refinance 1, 2, and 3, buy 4, 5, and 6. And this is what your portfolio looks like in 20 years. These are conservative numbers. This is actually a lower, obviously, number than what you'd buy at in Toronto today. So the numbers would be higher, but you still have mortgage, but your equity is worth 7.5 million in 25 years. And that's why this is so powerful. And to show you how it really works with my portfolio, real life example. So this is a look inside my portfolio. And this is the multiplier effect. So this is how it works so well. When I started investing, my pension plan that I was creating for myself was 10 condos. And it worked really, really well. And I started buying more condos. Not all of this is refinance money. But the majority of it actually is. And what's really important to talk about is, my portfolio today is worth $37 million. Okay, so there's a lot of leverage on that. I owe the bank a lot of money, but what's important is that there's compound interest on that. And over a long period of time, I'll show you the numbers. But if the market even went up 5% this year, my net worth would actually go up about 1.5 million. So even if the market only went up 1% this year, my net worth would still go up 370,000, and I could tap into that equity every year. And that's what I do. I refinance a number of these condos with Adam, and I pull equity, and then I grow that list even bigger. So today, my current value is 37 million. An important point I keep saying throughout this, it isn't about timing the market. It's about time in the market. And this is why I keep saying this. So the current value is 37 million based on a 4% annual compounded growth rate in 20 years. So that's a very, very conservative. That is way below the last 45-year average. Any shorter term average, way below it. So 20 years at that low estimate would be 81 million. In 25 years, it would be 98 million, and 30 years, it'd be 120 million. Just in 5 years, it jumps $22 million. That is leverage and compound interest. Now, let's use the actual compounded annual growth rate. So the actual compounded annual growth rate for the last 20 years is 7.5%, as I showed you for GTA real estate. If I use that, which I think arguably it will be higher because of the supply and demand constraints and issues that we'll be talking about, 20 years, that's a $157 million portfolio. When my marketing manager, Miko, helped me with this, he's very good at Excel. I was like, can you just check those numbers again? But this is the power of compound interest. So 25 years, look, just 5 years, it's $75 million. Another 5 years, it's $100 million. Look at that snowball. So 20 years to 25 is, 70,000 or 70 million. And then another 5 years is 100 million. That's compounding. That's unbelievable. You've, I'm sure, seen that in action, Adam.
Oh yeah. I mean, I love, like, when you lay it out like that, though, I get even more excited for myself. That's great.
So I just want to touch on this quickly. I want to do a whole webinar on pre-construction, how to choose the right condo and how to work with the right person. But, there's fundamentals I look for in probably every investment, real estate investment, because I don't just own pre-construction. I do own a few multi-res units that I have management for, so I'm hands off, so it works. But, what do I look for investing in a pre-construction condo? And it's always location. And what do I mean by that? Let's break that down. So the way I kind of break down investments is there's a blue chip investment and there's a value investment when I look at real estate. And blue chip is downtown Toronto. When I first started investing in real estate, I created pro formas. I said, I am going to get a 5% growth rate. I looked at what REITs were predicting, who own office buildings in downtown Toronto, who own multi-residential. They're coming to the downtown urban cores. These are their forecasts. These are the historical numbers. And that is blue chip. You know what you're going to get. There might be some ups and downs, but actually blue chip performs better in down markets as well. So, and then there's the value play, and value play is more of an area where you might actually see a higher return. So a value play for me right now is Hamilton. I'm investing a lot in Hamilton. I have 11, 12, 13 doors there right now. I just bought a few condos there, and I'll be buying more there. So that's a value play. And the reason why, I like value plays is there's, diversification to markets, a little bit more excitement, but there's a little bit more upside potentially. So you're buying at a lower price than the blue chip, but you're investing in the future. And what you look for to invest in the future is you look at government investment. So where is the government spending money? Hamilton, for example, all levels of government are investing $4.4 billion. Waterfront revitalization, downtown revitalization, transit revitalization, all these different things. So, you want to look at that. And typically when the government's investing, they've done their due diligence and they see into the future really well in terms of investment, and their real estate prices are going to go up. There's going to be gentrification. There's going to be growth. Transit, you want to look at transit. So if you're the blue chip areas, everyone knows this who invests in Toronto, you're going to get higher rents and higher prices when you're closer to the subway. And, the further you go away, even blocks, you can actually see average rents and prices actually go down, which is quite interesting. And then supply and demand fundamentals. And I'm going to get into this. And Toronto, a lot of Ontario, but Toronto specifically has some significant supply and demand constraints. The equilibrium is way off. I think it's what's going to push prices in Toronto very, very high over the next short term to long term. Not the very short term, because we are arguably in a recession, which we'll talk about, but the future for Toronto real estate has never looked brighter, and that's based, mainly on supply and demand fundamentals. So let's get into the Toronto real estate market update. This is, I'm sure everyone wants to hear what's going on. I wish I knew. I know a little bit, so I'll share with you what I know. So inflation, it's, obviously the elephant in the room. Highest inflation since the 1970s, causing rates to rise at the fastest pace in 30 years. Recession or not a recession, we don't really know. Depends who you talk to. And I want to get into really how it's impacting real estate in the short term. And then I'll get into how it impacts real estate in the long term, because, I don't think it's ever been brighter in terms of, what I talked about with supply issues. But annual inflation rate slowed. Some good news with inflation. It slowed to a 4-month low, 7% in August. It was expected to be 7.3%. So it was largely driven by lower gas prices. But that was positive news for the markets. And then also one thing to be mindful of, it's actually a lagging indicator. So the government is going to take money out of the monetary system to help curb inflation, but we don't actually see the impact of that until later. So it could already be taking effect. It may not, and we'll probably see more increases later. Core inflation slowed to 5.2%. Wage inflation, as rates increased, at a 5.4% annual rate, which actually wage inflation is an indicator of a potential recession. So it's great people are making more money, but it's also an inflation indicator. General consensus is the overnight rate to rise to 4% by the end of 2022, bringing inflation down to 3% by the end of 2023 and 2% target in 2024. Monetary policy gets us into a recession, then gets us out of a recession, money in, money out, money in, repeat, lower interest rates to follow. So, I'd love to hear what you have to say about that, Adam. Do you kind of see it that way as well?
Yeah, you did a great job explaining that. We tend to watch a thing. There's this thing that's called the yield curve, it basically would suggest, if you look ahead, looking at the yield curve, that unfortunately, as you just described, there's definitely room, and the government is going to get that policy rate to 4%. To be really precise on this call, I think that on October 25th, they're going to raise it by 50 basis points, 0.5 more. And then on December 6th, they're going to raise it by 0.25. So that gets us to that 4% you're talking about. And yeah. Our prime lending rate that all our mortgages or variable mortgages and HELOCs are based on will go up by same. So, okay. But the good news is what you just said, is that historically the government, this can be proven. If you can Google it, they always overcorrect. They go, oh man, we have high inflation. We better start raising rates. And then, as you said, there's that lag, and we're going to roll into the second quarter of 2024, So you're bang on there. Most economists believe it's the second quarter of 2024, and they're going to go, "Oops, we we uh, we overshot that a bit. We're definitely where we need to be," and then they're going to start reducing those rates again. So our chief economist's prediction is that. And back to that yield curve. It also shows that there's a lot of panic. People that are of a certain age. I'm not going to date myself, but they're worried. Rates are going to get into these 10s and 12s and 15%. And I'm brave enough today to say that's just not going to happen. Fixed rates are going to hover from now until the end of 2023 in those 5s and 6s, and prime will be in that same range. And then in 2024, prime starts to come back down again.
Right. And
I'm very optimistic.
Yeah, and I don't, I'm going to get more into this, but that isn't necessarily going to bring the market down. So this is why this is an important slide. So I started real estate. First of all, Canada is a cyclical interest rate system for all of the reasons that you just mentioned. And real estate, again, is a long game. And when I buy real estate, I don't factor in interest rates because I'm looking at a long-term hold. And I know that during that rates are going to go up and they're going to come down. I historically always go with variable rates, which aren't great right now, but I know in the long run will, historically outperform. So just to show, I've highlighted in red every time the rate has been, so this is the prime rate. Yeah, prime rate's at 5.45 currently. So, when I started selling real estate in 2005, rates weren't that far off. And, I wish I had price appreciation to go beside this. I ran out of time, but I did see it. And it was 5.5 to 8.5% growth over these years where we had really high rates. So we're going back to a more normalized rate market. And, you can see we were very fortunate. And this is interesting as well. So rates in 2008, then you see them getting us out of the recession, really lowered, and they stayed low for a very long time. So this is a really interesting chart. I'm afraid to click on it because it's going to take me away from this page. I may never get back. So I'm not going to do it right now. But for those of you guys who want to check it out, it's a really cool interactive thing that shows you the rates in all the different years. And I'm going to show you recession prices in the 80s and 90s. And you can see how high they were in the 80s and the 90s. So it'll be interesting to see what prices look like then. And then the cycle continues, and savvy investors don't panic. So as I mentioned, this is all part of the long-term process. And I knew this was going to happen at one point. And for me, if it happened tomorrow or in 10 years, it didn't really matter because I'm holding real estate for the long term. This is from Bloomberg. What goes up usually goes down. It shows what happened historically after rates increased. This is from Financial Post. Interest rates are still rising, but investors should be preparing for when they start to come back down. And then they talk about variable rates as well. So, just this last slide, economists see the Bank of Canada's rate hike peaking at 3.75, arguably 4%, but they're predicting it's starting to come back some even sooner than we were talking about. So
imagine if there was a real estate product out there that you could purchase and you didn't need a mortgage today, and you'd only need the mortgage later when rates come back down. Oh, I promise everyone on this call, I'm not on Ryan's payroll. I was being a little sarcastic there.
I do have a note to talk about. This is actually to talk about how to hedge in this market. And I probably would have actually forgot to bring it up. I didn't have time to make a slide, but 100%. I'm buying real estate right now. I'm buying pre-construction real estate because I don't have to deal with rates. And I know they're coming down. So what is the best hedge in inflation? It's not holding cash. Your cash just got devalued at 7-8%. Real estate actually appreciated, which we'll get into, but we know it's going to appreciate over the long term. So those averages are going to be considerably higher. Your cash is not going to come back up. You're going to lose money if you're sitting on cash. So, I'm putting my money in real estate. If I wasn't, I'd probably be putting it in gold or something, but you need to be putting in something that is not losing value. Housing prices generally perform well during recession. So this was shocking to me, and it made so much sense because I've been doing this so long. So it's interesting because I never actually dug deep into the 80s recession, the 90s recession. I wasn't around. I mean, I was alive, but I wasn't selling real estate. So I just remember, like, what about the 80s? What about the 90s? So this is really powerful. So when you look at this, so first of all, monetary policy gets us into recession, then gets us out. We talked about that. Only 3 major recessions in the past 30 years. 2020 wasn't real. So you could say COVID was a recession, but it wasn't. I mean, the government acted like it was, but it technically wasn't. 90s, people left Toronto. Now people are coming in. So let me get through this. So 80 to 82. So the price change 3 years leading into recession. This is important. So leading into the early 80s recession, prices went up 15%. Modest growth, 5% a year, let's call it on average. During the recession, when I showed you in that previous slide, rates were around 20%, prices actually went up 35%. And then prices went up, not the same trajectory, after the recession at 6%. Now, the reason why 80s was a little bit different is there was a lot of cheap inventory. So the 80s real estate in Toronto was very cheap. And I'm talking about Toronto specifically. Now, in the 90s, it was different because there was a good run after the 80s to the 90s. Now, what happened leading into the 90s recession, which older people are fearful of, is that prices appreciated 97%. That's 33% a year leading into a recession when rates went up. So that is very dangerous. And we actually saw something similar to that in this year in our arguable recession, or in the market anyway. But prices only pulled back 21%. So 3 years, a lot of people still made a lot of money. Not a lot of people bought at the exact 97% peak. So it wasn't, some more people were affected here, and that's why it lasted longer. But looking at 08, 09, our recession, it was a 20% gain going into it. And then it was 5% during the recession, then 9% going out. So that was when interest rates started lowering. You really started see it going up. And then in 2020, which is COVID, we saw prices 12% growth and then 13% during the recession increase. And, this is an anomaly. It doesn't really make a lot of sense. But, I think the really key thing to look at here is that markets overshoot. Okay. So when I invest, again, it's over the long term. I know there's ups and downs, and we don't always talk about it or see it, but there's always peaks and valleys. I saw one in 2016, it was 20%. The market corrected 20%. Everyone forgot about it in a minute because it corrected very quickly. But what happened is the market started appreciating so quickly because of supply issues, cheap money, and prices overshot in February and March. And people who watch real estate and know it well said there's, some people are going to get caught buying at the top. And that happened. But that doesn't really matter. I think I have my next slide. So there's a really great study. Zolo did a blog, and they went to homeowners who bought at the peak in February that have now gone down 20%. And they said, 4% of home, sorry, that's supposed to be 84%. That doesn't sound that positive, does it? 84% of home buyers are still happy with their purchase because people don't buy houses like they're buying stocks. They buy there to live there, or they buy there to rent it out. And rents perform better in these types of markets. So this is a long-term purchase, and they're still happy with their purchase. So, let's kind of look at what happened here. So prices adjusting to higher rates and changing market conditions. Market tends to overshoot in an overheated market. So this is the average low rise, high rise. It's the MLS average in all of GTA. So there's markets within the markets. Condos perform much better. I'll get into that. So the average price up 0.5% from July, 0.9% higher than a year ago. So year over year, we're still good, but anyone who bought in February probably lost 20%, and that's that overshot market. But they're not worried because we know it's going to go up. Average price is down 19% from February. Average price 36% higher than in August 2019. So that's kind of that 3-year outlook. 3 years out, we're only 36% higher, which is a lot of money, but it's not a dangerous place. If we're 100% higher, there might be more people that could get caught in price pullback. Another really important thing as well, and this goes back to this slide, there's panic. If people bought at a really high price, 97% increase, rates go up, and then it starts going down that much, there's sometimes a need for panic. And that's what happened in the 90s. I heard that people were selling, everyone was trying to get out of their deals, and a lot of people panicked, a lot of people foreclosed. That's not happening right now. And that's a really key indicator. actually real estate's actually coming off the market. So listings are going down. It's becoming an even tighter market, which we'll get into. Condo prices have proven to be more stable. Condos remain affordable for many and tend to perform better during volatility. I've been saying this for ages. You get a lot of upside with low rise, and it's very cyclical. There's a gap between high rise and low rise. And high rise just ran so much that I knew by putting money in condos right now, there'd be less volatility because there's an affordability gap and the condos were near the bottom. So what you see here is prices actually remained relatively balanced. The peak, obviously there's some losses, but look at these curves here with low rise. I mean, you're looking at markets in, Durham, Whitby, some parts of Mississauga, they had 20, 30% pullbacks. They also saw 40, 50% growth going into it. But, Toronto had modest growth, actually losses during COVID because of the mass exodus. But that's why there's more upside in Toronto, the way I see it with condos. So average price change by unit type, 6-month average is down for everything. I'll get into the month over month average. We've seen 2 months in a row of price appreciation, which is a good sign. And then the average price change over the last year, houses are down, detached rose up 1%, condos 4%. That's a mix of 905 and 416. 416 is actually performing really well. And then 3-year, detached is still up and condos are on the lower side. So the rebalancing of Toronto's real estate market, active listings dropping and months of supply following. So that's what I just got into. So an estimated, so let's look at this first. So here's the 20-year average for the Toronto Real Estate Board, 17,850 listings. We are actually below the 20-year average right now. So everyone's fear going into this, oh my gosh, people are going to panic, prices are going down, people are going to sell. That's not actually happening. It did happen to a certain extent, but they didn't get their price. They took it off the market and they started renting it. So an estimate, and this number is actually not accurate because an estimated 38% of listings are relistings. So everyone listed at February's prices, they don't get it, they pull it off, they relist it at today's prices. They don't get it, they pull it off and they rent it out. So, the market's actually quite dry, and it's still arguably in a seller market territory. Affordability is creating a different type of seller's market, but arguably a well-priced condo is going to sell very quickly. And this is why I look at the months of supply. So we've got 3 to 5 months supply is a balanced market for condos because there's way more condo supply than low rise. Below 3 is a seller's market territory. Above 5 is a buyer's market. We started, in July, we got to 3 months. That is pulling back right now. So our months of supply is actually going down. And that's why we're actually seeing very modest month over month price growth right now. Resales up 15% month over month, market conditions tightening, demand starts to move from the sidelines back into the market. So what happens when Toronto real estate prices, interest rates, government intervention create a slowdown in the market? People don't go away. They don't leave Toronto. They don't stop moving to Toronto. They move to the sidelines. So there's a sideline where demand just steps over that sideline. They're not buying, they're waiting. What are they waiting for? They're waiting for more positive news, probably more than anything. And they're waiting to see if markets tank, and they don't tank after a month, 2 months, 3 months, everyone jumps back in. So we're starting to see people jump back in. This is really positive. So, I mean, the market sales started really declining in April, and we're very flat. And now we're seeing a 15% month over month increase, which is still 53% below the 10-year average, but it's on the up and up. And that has to do with supply issues. Prices up for larger units compared to pre-pandemic. Affordability for families and working from home leads to better gains. So I've been talking about this for a while. When I started investing, those of you who work closely with me, I was buying studios. I'm like, they're the most affordable. You always have a tenant, a young professional. I was showing condos 15 years ago on the resale market to families. They would just say, this is the waste of time. Like, go show us a house. No one was living in condos. This is becoming the majority asset class for people to live in. And what that means is the price appreciation from smaller units that used to have way higher price appreciation and rent appreciation is actually lagging behind the larger units. The 2-bedroom and plus den Q2 2022 versus Q2 2019 is up 35%, and 3 bedrooms are up 31%. So those of you who know me well, I've been buying, I went from studios to 1-beds. I've been buying mainly 3-bedroom units, which when you factor deposits, it's not that much more money. The end price is much higher, but the deposit down payment isn't, and you get all that leverage. So you're going to make a lot more money doing that. To put that in perspective, the condo I live in right now, it's a 3-bedroom. I'm about to list it. I bought it for 1.6 about 8 years ago, and I'm about to list it at 3.2. So that's a 3-bedroom unit. There's way more demand. I actually have a 3-bedroom office. I'll convert it to a 4, and I'll have even more demand. So that's a really interesting thing for investors asking me all the time, what should they buy in? And it really depends on the market. In the downtown core, I still say studios, 1-bedrooms, but even as rents increase, you have more people sharing a 2-bed or a 2-bedroom and den or a 3-bedroom, and their rents are lower than going by themselves to rent a 1-bed or a studio. 416 prices, condo price premium over 905. So this is a really important thing to look at for investing in the GTA. So City of Toronto average price is 736,000. The GTA average is 711,000, and 905 is 656. So this shows the gap between 416 and 905. It is at an all-time low. In a good market, it's usually around high 20s. And during COVID, there was a mass exodus. People left Toronto. They didn't get to enjoy the Raptors. They didn't go out for dinner. They didn't get to enjoy the lifestyle. So they didn't have to go into work. So they went and moved to 905. It drove prices up there. And it started making Toronto look like a really good deal. Toronto, over the long term, is always going to be a major city. In fact, it's going to be one of the top major cities in the globe. And 905 saw its appreciation. I think it's still a great market, but I think there's a really good opportunity right now in the 416 to invest, because we're already seeing prices outperform the 905, outperform other asset classes like low rise, mid rise. And, that's because prices are relatively cheap when you compare it to other options. Detached versus condo price narrowing, but still enlarged. Condos continue to become the only affordable option for most buyers. So I just talked about the 905 416 gap, very narrow. So when that gap is narrow, I put my money in 416 because I know there's more value in 416 condos. People live there, they want to play there. It's like Manhattan type real estate, right? There's suburbs and there's the core. The other gap I look at is low rise and high rise. So everyone would love to live in a house in downtown Toronto. Most people can't afford it. So once that becomes unaffordable for the masses, demand shifts to high rise, and the gap is still very high. It's actually started to narrow, but it's a very high gap right now. Well higher above, I guess, than the last 10 years. So I think there's still a lot of price growth in the short and midterm in condo prices, just looking at that indicator. And rapid recovery sends rents above pre-pandemic high. So this is an incredible story, because Toronto rents actually got hammered while people left the city, and everyone just flooded back in. I mean, the city is crazy right now. It's amazing to see the downtown core during the day. In the evening, bars are full, restaurants are full. It's really great to see. Traffic sucks, but that's another different story. So this is crazy. Look at this. The rents just shoot up over a few months. 3-month growth was 11.4%. It's $300 on average for the average condo. There is no sign of this slowing down. And this comes down to supply and demand. There are so many people moving to the city, and our actual supply is going down below historic levels. So, the future has never looked better. There's a few things I like to look at. And, supply and demand, just to kind of put it in context, is the amount of goods and services that are available for people to buy compared to the amount of goods and services that people want to buy. If less of a product than the public wants is produced, the law of supply and demand says that the more can be charged for the product. I stole that from the Webster Dictionary. So let's look at demand. What's happening with demand? So Canada's population growth is setting records, shattering records. Our estimates well before 2021, I think it was in the 300s, and then that increased. So 2021 was supposed to be an estimated 401,000 permanent immigrants. 2022, they increased that to 411. 2023 increased to 421,000, half coming Ontario, 1/3 ending up in Toronto. So that number is actually considerably higher than the actual projections, which we'll get to in the next slide. But what's really important to keep in mind is newcomers represent 1 in 5 home buyers. So people are like, how are prices going to keep going? How are people, who's buying these homes? Well, actually, there are very talented workforce that we have to bring in because we don't have enough of a workforce here in Canada. So 1 in 5 home buyers, 75% actually come with savings to buy a home. Oh yeah, there's the previous targets I was trying to remember. So record high immigration, low unemployment, creating new demand for housing inventory. So this graph is the 12-month immigration for the GTA, and we actually had 160,000 newcomers come into the city, the GTA, many of them skilled, and 40,000 plus additional people over the previous 10 years. So we're growing very, very quickly. We already had a housing problem. Our housing problem is getting worse. And that is why price appreciation over the long term looks very promising. And that's why I want to own real estate. That's why all of the older families in Paris, France, and Milan, all those old Italian cities want to own real estate, because most people aren't going to be able to afford real estate. And most of the population will be renters eventually. So newcomers initially rent, but 75% come with enough savings. We talked about that. So this talks about employment, record level of job vacancies in Q2 2022, including the construction sector. If we hit a recession, unemployment will obviously shift. But the reality is we have huge vacancies in really important positions in construction and engineering and IT, and we're bringing highly qualified people to help fill those. So there we go. Okay. So immigration contributes to demand growth. So everyone's like, how are prices continuing to go up? Well, it's the demand and supply fundamentals. Established immigrants more likely to own than Canadian-born individuals. Also show an increased propensity to buy. So this is this goes back a while back, and I'd love to find an updated one, but I know this is accurate because I deal with a lot of new Canadians and newcomers, and they come with money. And they come from places, many of them, where real estate was actually more expensive than Toronto. So they're actually buying recent immigrants, and non-recent immigrants are buying the more expensive real estate than, Canadian-born individuals in all provinces. So that's what, is helping fill the upper part of the market, price part of the market. Housing supply constraints expected to continue. Housing supply declining while demand increases at record levels. So this is the story. I wish I had more time to put more together, but this is shocking. So in this graph here, this is the trend line for housing starts. It's actually going down. So we know that we need way more houses in the GTA. Our trend line is going down. So as a real estate investor, I feel really good. As, more of a humanitarian, I feel bad because home ownership is going to become very unrealistic for many people. This will drive housing prices up. Housing starts average 41,000 over the past 10 and 20, or 20 is supposed to be 20 years, needing 2.2 people per household formation. Sorry, I have a home automation. It doesn't think I'm here, so my lights are adjusting. So 60,000 per year, and we were building 40,000. Now that number 40,000 has been the average for the last 20 years. But now what's happening is we have supply issues, we have affordability issues, we have interest rate issues, we have supply chain issues. So we expected an extra 36,000 units to be sold this year to add to our supply, to our inventory, to help service all of these newcomers to Canada. And we believe now that'll be 10 to 15,000 units that don't actually come online to be sold. And those are for a number of reasons. Developers can't get the prices they need to make it financially viable. and supply chain issues. So and employment issues. We don't have enough people to help build them fast enough. So the construction industry is actually at capacity, and we don't really know of any way to build this. That'd be great if a bunch of land would appear like the green belt, but the biggest problem is that we don't have the capacity to build. And this kind of puts it into perspective what happens over the long term and why I want to hold real estate. The GTA population projected to increase by 1.24 million from 2021 to 2031 compared to 849,000 from 2011 to 2021. So we're seeing about 300, 400,000 more people come in, but we're building less homes. Population will severely be undersupplied for housing. Now, this is scary. I didn't have enough time again to do this slide. So what's crazy about the rental supply and housing supply is I'm talking about construction to build for people to live, to buy. So what makes up a huge part of that are purpose-built rentals. And purpose-built rentals have actually come offline. So this is an old chart that says we're going to have a short of about 16,000 units on the rental side between 2027 and 2031. But all of the applications that were actually in for rental, purpose-built rentals, REITs, they have now not moved forward with their applications. So we were expecting thousands of units to come onto the rental pool that will not come onto the rental pool. And that is another big reason why being an investor, a mom and pop investor owning condos in Toronto, is never looked better. And then just to put this in perspective, high cost making more projects unfeasible. So this obviously supply issues, the labor issues, but it's also the high cost. So this 49% increase in development charges. So essentially the city is increased the cost to build for developers 49%, which means it's costing us, the buyer, more money. So it's financially viable for them to build. This slide, I wish I could make bigger, but this is a really interesting thing to look at. So this is 2020. It's obviously now dated, but the fundamentals remain the same. So developer's profit remains around 10 to 14% of a project. Government charges are 100 to 150,000 per square foot. So they're a big percentage of it, almost as much as the developer's making. And then the construction costs are the majority of it, hard, soft construction costs, marketing, and then the land value. So the developer doesn't actually get left with a lot of money. So what happens when developers, the city adds increases in taxes, that squeezes their bottom line. What happens when trades, unions go and strike and they ask for higher wages? What happens when supply chain issues happen, costs go up? A lot of projects we're expecting to come online this year and next year are not coming online. So this is adding to the problem, and this is adding to why real estate investors, people should be buying real estate. Okay, so all of that, I've been going on for a really long time. I would love to just jump into this opportunity. It's funny, the developer from 8 Elm is actually calling me right now. So 8 Elm is a phenomenal project. I've been talking a lot about downtown Toronto. I've been talking a lot about blue chip real estate. This really is blue chip based on location, based on the developers, based on the rents and the resale market. Quick facts: developer reserve properties and capital developments. Sorry, I missed their name there. Two heavy hitters in the development industry. Address is 8 Elm Street, Toronto. So this is Dundas Square. This is the Bay Street corridor, the Yonge Street corridor. This is right in the middle of it all. Pricing starts from the high 500s. Those are for studios. Don't even focus on them. They're gone. As I showed you before, larger units are going to make you more money over the long term, and the deposit isn't significantly different. Occupancy is scheduled for spring 2027. It's realistic. This is a huge building. It's realistically going to be a 6 to 7 year build, which I like because it just appreciates in my filing cabinet, and then I call Adam. So 69 stories, huge building, 800 suites, and then ranges in sizes from 300 to 767. Reserve properties, huge developer. They've been doing it for a very long time. Capital developments have completed some amazing buildings. They're involved with with office as well as residential. They've partnered up on a prime piece of real estate to bring an incredible building. Just some quick renderings. This isn't your standard typical building. This is going to be a high-end building. Everything's standard in terms of finishes, amenities are over the top. It's going to attract a very discerning buyer in the future or renter. Location, to put in perspective, these are all subway stops. So, I mean, you're surrounded by subway stops. I've told you, you get higher rents, higher resale prices. Ryerson, I forget the new name, is 36,000 students in walking distance, U of T walking distance, over 200,000 jobs in the financial district. So amazing location. Deposit structure is really good. So they're doing 15% and then another 5 on occupancy. 5 occupancy is probably, like I said, 6 to 8 years out. So you're putting down 15% over 540 days, which is really good. Incentives, VIP pricing, we're getting at the very, very beginning. You can walk, here's the challenge with VIP investing, platinum VIP investing. A lot of people claim they actually have access. I just got a call from the developer because they were telling me I had units and I probably have to sign them. So I am getting units. A lot of the noise out there, people don't actually have access. This is the first opportunity to buy. It's at the entry level pricing. It's the IPO of investing. Prices are going to go up probably as soon as next week. And then they're going to release to more agents, increase and release to more, increase. Deposit we talked about. Closing costs are capped. Free assignments, I'm a buy long-term and hold, but you have the opportunity, the option to assign and flip. I have a client who is very wealthy, makes a very good living, staggering condos, 1 or 2 a year. And that's a good business for him. And then free property management. So my company takes care of everything for you. We make it as simple as owning a mutual fund. We want to make it easy. It's hands off. We'll find the tenant, choose the finishes, manage the property for you. And that's included for free for the first year. Now, a quick financial breakdown. So I used a 7.49% growth rate because I'm going to show you that as the long-term average in this area. And, these studios probably aren't available anymore, but this $583,000 studio, assuming 6-year completion, 7.49% growth, rent increase of 6%. I used to use a 4% conservative rent increase. I think 6 is conservative based on everything I know that's going to happen in terms of supply. And a 4.25% mortgage rate, that's what's available today. That's going to be lower in 6 years. I feel very confident about that. So future price is $900,000. If you're renting it out, you actually have cash flow based on these numbers. And then total cash flow and selling profit. So if you're to sell in year 1, you would look at a profit of $321,000. So your deposit on that, I wish I had here, but it's about $120,000. You would more than double that. So that's about over 200,000, 200% ROI. Now, these are the units. So I do a lot of research. I want to educate my clients. I don't want to sell everything. I want to sell projects that I think are in an area that performs over time. This is one of those areas. And I've used these buildings that are in the Yonge Bay Street corridor, and they are within 6 years old because older buildings don't appreciate the same as newer ones. So this is pretty staggering, and we'll send you an email of all this stuff. But based on the launch price per square foot, there was an average of 701. Based on today's prices, there's an average of 1,600, which is a 218% ROI, 7.5% per year. That is an amazing average, and that's because it's blue chip real estate. And what I like to break down even further to see what that looks like in dollar cents is if you were to put down a 20% deposit on these condos 6 years ago, or at the original time of purchase, launch dates are here. So, anywhere from 8 to 10 years ago, it looks like these are seeing profits of 475, 331 to 750,000. And these are all in this area. And that's why it's important to invest in blue chip real estate, because you know what you're going to get over the long term. There are always going to be people that need to rent and buy and live next to universities and subways and to where all the jobs are. So to just kind of break it down a little bit further, this is really impressive. So the price per square foot is higher than resale prices, but the end prices are actually lower for a lot of unit types. So the studios are 6% higher in 8 Elm, 7% lower than one beds, 16% 1+1s, 2%. These are the starting averages, and these are the current resale averages, but it's 13% lower in 8 Elm. So I think there's some incredible value. And then with the 3 bedrooms as well. Rental rates, these are based on the current resale rates, our current rental rates in the buildings we're talking about. Studios on average 2,300, one beds 26, 1+1s 3,000. $4,000 for a 2-bed and $5,200 for a 3-bed. So I mean, days on market are very low as well. So there's a huge amount of demand for these. I just talked forever. Adam, we got some questions for you. Well, I ask you some questions, and I know I have some from my team as well. I'm just going to keep this slide up here so that anyone who wants to reach out to me, my team, can reach out here. Anyone who wants to reach out to Adam to learn more about, what I do, essentially why I talk to Adam every week and keep asking him for updates, is because I'm pulling out equity of my home out of my investment properties, and this is what's adding the fuel to the fire of my portfolio. Adam, before I just pull up some questions,
yeah.
Why don't you give us, I know you already added your 2 cents, but like in terms of, for investors in this type of rate environment, and what do you suggest for people to do? I know the questions are going to be variable, fixed, like, how do we kind of navigate in this type of lending environment?
Stop watching the news. Hop on some, great seminars where you're getting the facts. But I mean, all kidding aside, I do tell people that, if you want to get into the game, you have to work with professionals. And my advice would be, regardless of what's happening with rates, I mean, you've done an amazing job this evening, Ryan, sort of describing what's happening with value for real, what you talked earlier about, really what's going on with rates. We're okay. It's the new normal for a little bit. I say still have that pre-positioning. Get organized so that if you want to be a real estate investor, you can be. There's so many great products out there. I mean, just because the bank's saying no, there's just dozens and dozens and dozens of other lenders and other banks. That's why it sounds like a bit of a toot, but I always tell real estate investors they really should align themselves with a good mortgage broker. Definitely very important to know a number of bankers as well, all part of that diversification. But just because your bank's saying no, or maybe you haven't even tried, there's lots we can do in the current environment mortgage wise.
Yeah, and I think that's really important. So, a lot of people, me included, I thought I was just, stuck for a bit. And, then Adam was like, well, no, there's B lenders that are going to lend you money all day long. So we started looking at that option. And, I assume B lenders, oh my gosh, the rates are going to be considerably higher. But today the rates are not that much different.
That's actually an amazing segue. I'm going to tease you a bit with the B lender. You've heard me say this before. Whenever I have an opportunity to speak to large groups of realtors or whatever, I always say, stop saying B lender, because the general, we did that to ourselves, because behind the scenes, and you're very experienced with this, that, that's how they were categorized, but they're really alternative banks. And more and more Canadians, whether they're investors or not, are taking advantage of what's available at the alternative banks. So you have to keep an open mind. Any good investor keeps a very open mind, and like Ryan, that's you do keep an open mind, and that's why you've been able to accumulate so many properties.
So I've got more questions. Someone's going to send them to me right now, but one of them was, I think you kind of just answered. I got declined by my bank. Are there B lenders out there who will give me a mortgage?
Every situation is its own situation, but just because, I will reiterate, just because the bank is saying no, and by the way, every major bank, and Ryan, you would know this, every major bank also has their own set of rules. It's hilarious. Like, no two banks are the same, and they're constantly changing things. There was a period of time, I'll tell a story where, I won't say the name of the bank, but they have a green logo. But anyways, they behind the scenes, they didn't want to increase the amount of mortgages they had on investment properties. This was going back a few years. So they changed their down payment to minimum 35% down on an investment property. Now, we all knew and know that it was 20%. Every other bank was 20%. But I always knew someone was banking at that bank, because they would come to me and say, do we really need to come up with 35% down on an investment property. And it's like, well, I know where you bank.
Yeah.
And so the moral of the story is you can't just take one bank's word for it because every bank is different and there's tons of other solutions.
One of the questions, what is the difference between working with a mortgage broker like you and working with my bank?
Well, I'm way more handsome. No, I'm just kidding. The main difference, the main difference is that a modern day mortgage broker, their services are free, unless there's private mortgage solutions where a broker may charge a fee, but ordinarily the bank pays us if we do a good job and earn your business. And we work with 50, 60 banks and lenders, including many of them you could name, versus you just dealing with a bank. Some of the banks have an alternative lending side, but it's very unilateral. So that's the main difference. But I like to think that another difference is that most of us would agree that the people in our bank branch, especially nowadays, are disappearing. They're constantly changing. I was dealing with this mortgage advisor and now they're gone.
Yeah.
And a good mortgage broker, a good mortgage professional has been doing it for a very long time. All we do all day long is talk about mortgages and do mortgages. We're not brand new or anything like that. So I think hopefully there's some, professional consultation you get from working with an experienced broker over a bank.
I think that's an important point as well. Like the underwriting is the challenge. So it's like, I go to you, I go to a mortgage broker and it's like, I got to go to my underwriter and they're busy and there's, going back and forth. So it's like when you work with someone who has experience, they know the underwriter and that could be smoother. Otherwise, I think the experience based on the relationships with underwriters are the difference between getting mortgages sometimes and not getting mortgages.
100%.
Okay. Is this a good time for assigning a pre-con condo? That's for me. No, I don't think it's a good time to be assigning. The market's a little bit soft right now. You want to be an investor selling to an end user at market prices. There aren't a lot of end users out there that are looking for assignments right now. So you're going to leave money on the table. You're going to be an investor selling to an investor and you'll leave money on the table. Now, I'm not against assigning, although my biggest regrets in real estate are the ones I've assigned. It'd be worth a lot more if I never assigned them, but you can make a very good business assigning condos if you have long closes and you are doing it through a corporation, because the taxes on an assignment are very, very high, and doing it through a tax helps defer that tax. Now's a good time to be finding assignments, so you reach out to my team. How do you compare a 3-bed in Daniels on Parliament to 8 Elm? Parking is very limited in 8 Elm. Would you buy a 3-bedroom with no parking? Yeah, so you do not need parking for 3-bedroom condos in downtown Toronto. We did a market analysis last year where we took 2 bedrooms, 3 bedrooms with and without parking. And we saw the average price difference and we saw the average days on market. The average days on markets were relatively the same. And the average price difference was around $75,000. So, depending how much you pay for parking, you could actually be losing on it. That area in downtown Toronto, in 8 Elm, you're going to be renting most likely to professionals who are going to pay higher rents because they can rent together, which ultimately lowers their rent versus getting a 1-bedroom and studio. So that's why 3 bedrooms do well in that area. In terms of Parliament, Daniels on Parliament, you'll probably end up renting to a young family who will rent a 3-bedroom. And again, you don't need parking. Their parking is considerably less than 8 Elm. So I would buy it because you'll make money on it, but it's just not necessary. Parking is not necessary for any units anymore. Unless you're buying a penthouse, that someone's going to live in, you're not going to rent it out. And it's going to be an end user who has a lot of money and probably drives a lot of cars. Where do you see rates going in the future? I know you kind of touched on this. So they're just asking, where do you see rates going in the short term and long term?
Yeah. So contrary to the news fear mongering, sorry to pick on any newscasters on the call, but look, the short version is some very smart people, I call them the smart people, the economists, and a lot of really important statistical things like the yield curve show that we're going to end up in that sort of 6% range for rates, and we're not going much higher. I'm brave enough to say that now. And then rates will start to come down again in the second quarter of 2024. So you guys can email me if I'm wrong, but we will not be getting to 8, 9, 10% or anything crazy like that.
And would you recommend a variable mortgage right now or a fixed mortgage?
I've always recommended the variable rate mortgage. You can Google it. Actually, you can Google 30-year mortgage fixed versus variable in Canada or something like that in Google, and it'll show you that over the past 30 years, anyone that took a 5-year variable versus anyone that took a 5-year fixed, variable wins some crazy amount, like 95% of the time. However, right now you're not, like back in the spring, you could take a variable rate and you were way lower than the fixed rate. Right now, you're going to take a variable rate and you're going to be about the same as a fixed rate. So you got to be a little brave. Yeah. But then only the people that take the variable rate will reap the rewards of rates coming down in 2024.
That's what I'm waiting for. I got a lot of variables and it's gotten very expensive.
And everyone's been getting, and you mentioned earlier, unprecedented pace of rates going up.
Yeah,
it's insane. So that's why I look 97 years old right now, is because we're just fielding so many phone calls because everyone's getting these letters, just constant letters. Your rate went up, your rate went up, your payment went up, your payment went up. And it's frightening, and you consider locking in. But if you had a good variable rate discount, you're good. I will throw into that though, we are doing a lot of alternative bank mortgages, B mortgages, for a lot of different reasons for investors and just general case. They're great mortgages, they're great products. The only issue is they don't do variable very well. So in those cases, what we're doing is we're looking ahead and we're saying, you know what, we probably don't want to come up for renewal in 2023. Let's take a look at this in 2024. We're recommending 2-year rates, which gets us to that next point in time where hopefully rates have come back down and we're renewing.
How much lower? So you're recommending 2-year fixed rates
with alternative banks? I'm doing it a lot.
But why wouldn't isn't the variable pretty close to the 2-year fixed, or is it way higher?
Sorry, I might have rambled through it, but alternative banks don't offer variable rate discounts. They're like a prime plus situation, so their fixed rates are better. And almost every other case, again, it's very individual. It depends on the overall plan. And you have to be able to sleep at night. But I always recommend variable.
Yeah.
However, sometimes there's a plan. Sometimes you're planning on refinancing that condo in 1 year. Well, maybe you take a 1-year rate. So we try to customize it.
Yeah, and I think variable rates as well, they give you more flexibility, right? Like if you may sell in a year or you may cash out, like there's
more penalties.
Yeah.
You can also lock in at any time if Adam's wrong.
Why 2024?
That aligns with what Ryan was saying earlier about how there's like a lag and the government is constantly evaluating that inflation mark. And the only reason rates are going up right now is they're trying to get inflation down from 7.5, wherever it was, back down to what, 2? So the thing is we were actually excited that inflation had come down a fair bit back in July or August. But the government was concerned it hadn't come down fast enough or hard enough. So what do? They raise rates. They get really aggressive. They get really scary. They say there's going to be 2 more increases this year, October 25th and December 6th. But then 2023 should come down. They'll feel that the rate is high enough and that inflation's coming down enough. But then they're going to realize in the second quarter of 2024, oops, like we overcorrected, and they're going to want to reduce the rates.
Yeah, and it's really interesting as well, because I wonder what part variable of the equation is supply chain issues, because there's, it's really interesting when I talk to people in manufacturing and work for big companies or manufacturing products themselves. And, a lot of the supply chain issues is that they're still fulfilling orders from 2 years ago because their factories have been shut down. It's like once that gets caught up, which a lot of people said they need another 6 months, 12 months, once those supply chain issues, that is a huge component of inflation, which we've kind of forgot about. But I mean, I guess we can't rely on the government.
Well, also, I feel, I feel the government, like they always do. The reason the government picks on mortgage rates and the housing market is because it's the biggest piece of the pie. It's the easy way out. It's the easy way for them to fix inflation. They could address other things, and that's for another call, another day. But they go after real estate and interest rates. They don't talk about how they injected so much money into the Canadian market over the past couple of years, and that people were shopping their brains out and home shopping and all blah 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 blah. There's all kinds of other factors, but housing. Let's face it, the real estate market's the big chunk of the pie, and it's the easy fix for the government.
Yeah, and I don't think I really went into detail on this, but maybe I touched on it. But what's real estate it's a major GDP indicator. It's the number one thing that drives job growth, GDP, productivity. So we need it to get out of recessions, and we need it to have a thriving, booming economy. So it's not like this is like they're punishing real estate. It's really just to kind of give it, the economy some sort of spike. And then this will be what really real estate's what's going to get us out of any type of, whatever this is, recession or not recession. So they need to do that by lowering interest rates. And that's why it's been cyclical, and it's always been this way.
Yeah.
What else do we have? Why 2024 fixed? Where are they going? All right, I got one for me. What type of unit should I buy? I mean, we kind of went into that. Really, it's, it depends on the area. I haven't bought a studio in a long time. I've been buying 2 and 3 bedroom units because that's where, the shift in demand is going for families to own condos. You have that, but also as rents increase, you have the demand for the rental market. So if a studio becomes too unaffordable for a student, an international student, then a 2-bedroom becomes more affordable for 2 international students. So I'm focusing on the larger units. People are asking me where I'm investing right now. I'm investing in pre-construction condos. Adam's working on my refinance right now. It's hopefully going to come through this week. I'm ready to go on another project. There's Alias Condos. I have a really good low deposit deal for a downtown project. Anyone who wants to learn more about that, reach out to me. 7.5% deposit, downtown core, really good price per square foot. Forma condos, a really high price per square foot, but for a luxury building, what it is, I think there's incredible value. I can do a really good deposit structure on that. So I'm literally just waiting for my money to come in, and then I'm going to be buying more condos. So yeah, that's where I'm buying. Downtown Toronto. I bought in Hamilton recently, probably buy there again, but right now, based on the price gap between 905 and 416, price gap between low rise and high rise and the 416, I think there's a tremendous amount of upside in Toronto. Also, what's really fascinating, in 2008, the recession I was around, in 2016, 17, when prices got hit really hard, Toronto real estate always does well. Urban core real estate always does really well. So when you're buying the blue chip, you know what you're getting. You're taking less risk, and you're getting more long-term growth, appreciation, and rental growth. So that's where I'm looking. I think, Adam, we'll end it at that. Yeah. Guys, we'll tune in. We're going to do another one. We're going to give you some updates as the economy and rates start changing to the more positive. Reach out to Adam. He's helped me with my mortgages. He's helped me with a few refinances right now. And if you guys have any questions about investing in anything real estate related, I'd love to help, whether it's in Toronto, Hamilton, or surrounding areas. My team can certainly help you. So thank you, everyone, for tuning in, and I look forward to seeing you all again in the future. And thank you, Adam. I appreciate you here for the mortgage related questions and for helping me build more wealth. Appreciate it.
Thanks for having me, Ryan. Appreciate it, bud. Have a great night.
Yeah.